All right, welcome everybody to another episode of the partnership. It is a Halloween episode, so this is the spookiest episode to date. And I am super excited to have with me Mark Brigman, who is the CEO of Partnernomics. And we are going to talk with Mark about one of the biggest deals of his career. But before we go into this, I just wanted to say that today we have more than 90 people signed up, and I'm super excited that we're hosting another giveaway for you all. So if you've been to a partnerships episode before, you know the deal. If you haven't, just make sure that you comment hashtag this ship in the comment section right now, live on LinkedIn. And at the end, we'll be giving away resources from Partnernomics worth $595. Super excited. And with that, Mark, I'm super excited to have you on and tell us a little bit more about the 5 billion partnership between Sprint and Ericsson.
Yeah, thanks for the invitation. It's awesome to be on here. Special Halloween edition. I mean, this is some legit production, so it's great to be on here with you. Thanks.
We like to have fun.
Awesome, man. Well, you're doing a great job. Yeah, so my name is Mark Brigman, CEO of Partnernomics, and this is definitely the $5 billion deal that I was a part of with Sprint. Is certainly by far the biggest of my career. Working at a large company like Sprint, 85,000 employees at the time when I was there. I mean, you do a lot of big deals, so it's nothing to do a 10, 20, $30 million deal. But yeah, 5 billion was definitely pushing it to the next level.
Yeah. Well, I'm so excited to hear more about it. And I just wanted to give a shout out to Daniel and Marco as well, who joined us live in the chat. And if you have any questions about large strategic alliances or strategic partnerships in general, for me and Mark, just make sure to drop them in the comments as well. And with that, I would love to understand a little bit more about, what was the deal between Sprint and Ericsson like? Like, what was the problem you were trying to solve? And then more importantly, like, how did you approach this deal as well? Like, how did you make the build by partner decision that this was a moment to partner versus maybe build something in-house?
Yeah, so it was a bit of a unique situation, I guess. And kind of the way that I would tee it up is Sprint at the time was always kind of this distant third wireless provider. So Verizon, AT&T always kind of being the big giants up there, and Sprint was trying to compete as a number 3 and T-Mobile as a fairly close number 4. And so, whenever you look at profitability, there's 2 ways to increase profit, right? You either have to increase revenues or decrease costs. And so obviously there's all of these initiatives trying to increase revenues, getting more customers, lowering churn, doing all this stuff on the revenue side. But there's also some opportunities to do that work on the cost side. And that's exactly what this partnership was. And so essentially what the board and other executives at Sprint said is, hey, you know what? We kind of have this hypothesis that maybe Sprint should just be a marketing company of sorts. And so what if we took 6,000 employees that run our network, run, manage, operate, break, fix, new builds, all of this sort of stuff, 60,000 cell sites. What if we took those 6,000 employees and we actually had them work for a partner, and then we could leverage the economies of scale that partner would have. And so really it was more of a cost savings initiative that was underway. And it was as you can imagine, super, super complex. The first version of the agreement, I think, was 600 pages. So a gigantic deal that was literally years kind of in conversations and discussions, as you could imagine. Nothing like this had really ever been tried or attempted, and certainly not, a $5 billion, 6,000 employees being shifted over to a partner's organization. Nothing like that had really been tried before.
Yeah, I can imagine. And what was like the mood in the team? I mean, given that 6,000 of your colleagues would move over, like, are these were these colleagues excited to be part of Ericsson and like be part of a team which really prioritizes their work versus
You know,
like being part of an organization which does everything a little bit, or was the mood more mixed?
um, it was certainly mixed, and most of that just being, as you would imagine, it was tried to keep it a secret for as long as possible. And it kind of like it looked a lot like an acquisition almost,
Yeah,
right? Where you're talking about moving, literally rebadging 6,000 people to a different company. And as human beings, if we don't understand something, we automatically throw up the walls, we throw up the blocks, we kind of fear the unknown. And there were 6,000 people that their world was about ready to be changed very significantly. And then even from like a leadership perspective, there's different executives up and down the org chart. They didn't even really know what that meant for them as a part of this new organization. They had spent a significant amount of time and invested a lot to build their career at Sprint. And now, next thing you know, your paycheck has another brand on it. So there's a
yeah,
lot of unknowns. And so there was certainly the two organizations were very different culturally, as most companies in general are different, culturally. US based Sprint and European based Ericsson, and that's the first of 50 differences between the two organizations. And so
yeah,
there's certainly a lot of cultural differences. But yeah, it was really interesting to just see the different dynamics of culture and how that played into the kind of the full mix of this.
yeah. Definitely. It's also interesting that, it's a $5 billion deal and you would prioritize thinking about like the money oftentimes. But in reality, like 6,000 people's livelihood is like no joke. Like there's like a lot at stake for this, not just on the financial side, but actually also from an employment side, mortgages, houses, etc. Like this is a very high stakes partnership.
Yeah, no question about it. And I was really impressed actually with what I saw at Sprint with their executives and their genuine care and desire in this. And literally they believed that this was, even those employees, even though there was going to be a bit of a shakeup, they were going to go to a new company. It was still in their best interest because it was going to make Sprint as a corporation more viable. I
Yeah.
mean, literally called network advantage. The idea was we could create a competitive advantage because Sprint did not have the economies of scale that Verizon, AT&T had. And so this
Hmm.
was an opportunity to try to create a competitive advantage,
Yeah.
increase profitability, but do it through a cost savings effort, just by being more efficient on the network management and maintenance side.
Yeah. And you mentioned AT&T and like Verizon, etc. Like how was the deal perceived by the competitors? Like was this was not standard practice, like you said already. Like this has
No, it
never
was
been
not.
done before, right?
It was a big deal, no pun intended, across the globe. People are like,
Yeah.
what the heck is going on here? What are they trying? Okay, let me understand this. And then, honestly, it was a lot of kind of, well, let's sit back and see what happens. And so
Yeah.
either this is going to be the new trend, the new wave, it's or it's not going to work.
Yeah.
And so that's kind of what the view was okay, let's wait back and see what happens here.
Interesting. Yeah. And so how was this deal negotiated? I feel like that's something which I would love to understand as well because 5 billion is such a large number. Like it probably didn't come out of thin air. Like that was something. It was like substance behind it. And like, what were the most contentious terms or the most important terms that needed to be figured out?
Yeah, so a lot, to it, as you can imagine. As I mentioned, it was years in conversation, but kind of in general terms, what we did at Sprint is to try to figure out like what is the cost, what is the true all-in cost of running our network each year. So these 6,000 people, plus all
Yeah.
of the network assets and all of the software, hardware, break fix, all of this stuff, even consulting services, everything that goes into this. What is the all-in number? And
Yeah.
then what is the number we would like for that to be? So to use round numbers, let's say it's $1 billion a year to run this. is it possible to partner with a company that has more scale and probably and even more expertise in this area than we did? Is it possible to go from 1 billion a year to 800 million, or
Mhm.
850 million? Because if we could do that, that would be significant. That would be our
Yeah.
definition of a competitive advantage. And so really that's kind of how the numbers shook out, is to learn what our run rate was, essentially what our burn rate was, if you want to say it in those terms, for running that, and then what do we think we can get it down to, or really what can we negotiate to get Ericsson, in this case, to take the deal, but to really, more than that, to really be motivated and truly equipped to be able to deliver on that.
Yeah.
Um, yeah,
And
so that's what we were pushing for.
yeah. And I get it because it's so interesting, right? Because partnerships, the basic definition of partnerships could be that it's just a relationship between two or more companies that give you an edge. And the edge can be like more revenue, but it can also be cost savings, right?
Yeah,
But
absolutely.
I'm curious, what do you think was the motivator for Ericsson? Like, what do you think was at stake for them? Because normally when it comes to these kind of negotiations, like both sides have pressures, and like it seems like on the Sprint side it was to cut costs. But was there something particularly motivating Ericsson apart from just this is a huge deal?
Yeah, I mean, that's their core business, right? To them,
Yeah.
this was like a gigantic sale. Ericsson, the part of the division of their business that we were working with is their professional services organization.
Yeah.
But instead of them kind of doing 100 or 200 or 300 people's worth of work, they were now doing 6,000 people's worth of work. I mean, this was a giant whale for them. So for them, it was more of kind of a traditional, hey, let's go land a deal, let's go make a sale. But obviously, just because of the strategic nature of this, it was so much
Yeah.
bigger than that. But to kind of piggyback on the previous question that you asked about, like the structure of the deal. So for Sprint's perspective, what we were looking for is more of performance based pricing, more of like variable pricing and performance based pricing. And almost like there's a lot of different organizations that structure partnership deals in a cost savings manner. So, for
Mhm.
example, some of our clients are in the shipping space, and it's about
Yeah.
shipping spend, or energy consumption, or the lack thereof, right? Energy savings. And so for us, I mean, we knew we were spending, again, just to kind of use this round number, $1 billion a year to run, manage, maintain our global network. If we could get that down to 850 million, and then do like a share of that as well between us and them, then we would both win. But of course, Ericsson's looking for guaranteed money, flat rate, very predictable, low risk. So you always have these kind of, this dichotomy whenever you're negotiating deals of what's better, fixed versus variable, those sorts of things. So that was definitely put into the mix as well.
Yeah. So interesting. And like what I find, particularly interesting now as well is like at Partnernomics, you actually host a negotiations course as well. And
Yeah.
so taking your putting your negotiation, teacher hat on, what do you think went well, and what do you think partnerships leaders could do differently when they negotiate such a big deal? Or
Yeah.
what are the, like the pitfalls people should watch out for?
Yeah, so as I mentioned, like the initial deal was 600 pages, and so it wasn't
Yeah.
like a negotiation. It was like literally hundreds
And
of
they're
different
like connected with each
negotiations.
other,
Yeah, that
and
are
there are a lot
kind
of
of
moving parts. Yeah.
putting this puzzle together.
It's
And
like a spider web of
yeah, absolutely,
different
like a
items. Yeah.
huge spider web, like the one right here behind me. But yeah, tons of different components there, and lots of different people negotiating deals. And frankly, some very
Yeah.
skilled and some not, quite so skilled. But generally speaking, especially speaking for like our team, we truly tried to make sure that each side was going to win. And so we I truly feel like we did not play like this zero sum game where it's just, try to beat them down to the lowest price possible to have this piece of the puzzle brought in, but really trying to do our due diligence to ensure that they were incentivized to
Yeah.
deliver for us, because we knew if we just had hundreds of these little micro agreements, these little micro negotiations of, yep, we'll do it for X dollars. But if it doesn't work for their balance sheet, we know we're not going to have a partner in the end. Right? If they're not performing, we're in trouble, because we're going to have tens of
Yeah.
millions of customers that are not going to like their cellular service that they're getting.
Yeah. Yeah, and that's such an important piece of these large alliances as well, right? It's not like buying a car where you just beat all the value out of the other side and then just like get the car at the lowest price and drive off into the sunset. Like you actually are stuck with each other afterwards, which means if you do these negotiations, it's important not to extract all the value that you can, but actually maybe leave some money intentionally on the table just to give the other side wiggle room to then actually still provide a service, even if it maybe cuts into their margins a little bit, right?
Yeah, and I think what's even more important, or something additional to think about, and we certainly encourage doing this, and that is, um, think about incentives. I mean, so what is, you got to make sure like the bases are covered so that both parties are set to win and be able to pull value from this agreement. But if they perform bigger, better, faster, whatever the metrics are, if they overperform relative to what you need, and put the incentives there, let them win with you. Don't make the win be one-sided, but let your partner win with you, and structure deals that way. And I
Yeah.
think, we were able to do that in a lot of cases.
Yeah. Yeah, it's really important to have that better together story, right? Like that, why are we both winning from this deal? Why is it not just you beat like, selling something to us or us, getting a good deal here?
Yeah, and I think it also really brings, one of the things I wanted to really make sure that I said during this session is, there is a difference. We use the word vendor a lot, but there's a difference between a vendor and a partner.
Yeah.
And one of the things that I saw, right? So, like, even from our side at Sprint on this partnership team, it was about 100 people. And there was a large group of folks that had a background in supply chain management.
Mhm.
And not to disparage my supply chain management friends at all, but what they typically do is manage vendors. And managing vendors is all about, beating them down to the lowest price you can get, the highest service level agreements. And as soon as they stumble, you want to be there with the stick to beat them with it, and to, have some financial compensation come your way for their underperformance. And that's vastly different than truly managing a partner, and going into a partnership. And, I feel like the commercial team that I was on, that was right in the center of this deal, um, we were always encouraged by our vice president, our leader, our ringleader. He said, man, the first thing that you have to do is say, if you were in their shoes, would you sign this? I mean, is this a good deal for them? And we had to answer that question before we could even answer it for Sprint.
Yeah.
And that really left a big impression on me.
Yeah. Definitely. That's a great mindset and it's important to have a leader like that on your side. It seems like the audience really agrees as well. We have Ignacio joining us, who said, "Let your partners win with you" is a standout quote. I totally agree. And then my friend Antonio is in the chat as well, and he said, "Set the foundation for the win-win, but also have incentives to win even bigger." So I guess like a question from that is like, was there like a variable component in the deal as well? Like, how would you approach that? Because I guess you don't want to make it all variable because there is setup costs involved and like all that. But at the same time, you do want to leave room for, a growth story together, right? Like for upside on both sides.
Exactly. So the way that the deal was structured in general terms is, there was a base there to kind of cover the base costs. And then we had different metrics, right? So it's all network driven, right? So imagine mean time to resolution, network coverage, network outage. What's your response times? What do our customer satisfaction of our network performance?
Yeah.
How's the network speed doing? All of these different things, right? These are the metrics of, are we doing well or not? And so you
Yeah.
kind of have the baseline of payments that go out, but then the variable piece was all based upon cost reduction that they could provide to us, because of their economies of scale and their expertise in this space, but then also based upon improvements of performance. And so, are things getting, fixed faster? Are customers more satisfied? Do they have greater levels of bandwidth in the northwestern region of the U.S.? And so these were we had some benchmarks, some baselines of what these important metrics were all the way across the network from top to bottom, with performance, with break fix, with all of these pieces, and that was the benchmark. And so the incentives were put in for improving that, and then penalties for the opposite. Right? If the mean time to resolve a fiber cut or something like that in Oregon was typically 6 hours, and it took them 8 hours, there was some penalties that were put in it as well. So incentives go both ways.
Yeah, that's so important, right? Because these long documents, like the 600 pages you mentioned, they're not important when things go well. They're important when things go south. And oftentimes in the beginning, everybody's so excited, the better together story, etc., and they don't pay as much attention to these. But that can get really, really intense once your entire infrastructure is based on the partner.
Yeah, the best agreements are the ones you never have to look at.
Yeah.
Right? You do the deal, you know what the financial terms are, and you never look at the deal again. But in this, it's a bit of a different case, but your
it's so big,
very well taken.
Yeah, exactly. My general philosophy is that when you have to look at the paper again, your partnership and your relationship has probably gone so far south that it might be beyond repair at that point. If people actually start looking at the paper. But obviously, this is, the deals I've handled so far are not $5 billion deals. So the stakes are different. I wanted to zoom in a little bit more and just understand what your role was within the partnerships organization at Ericsson and at Sprint, and how big this team was and just how it was structured.
Yeah, so there's about 100 people on the Sprint side, and so we had a VP that was responsible for this entire Network Advantage deal, and then there was 3 different directors. And so one was in basically a project management function. The other one was a network performance function, and so that person's team was looking at all of these different network metrics, and they were kind of deciding, hey, do we owe more or do we owe less because the network is overperforming, underperforming? And then our team was by far the smallest. There was only 5 of us, and we were on the commercial team. And so really our job was to kind of sit in the middle and truly be the relationship managers for the commercial side. And so the initial deal was, 600 pages, but believe it or not, that was just the start. And so my day-to-day job was to figure out, okay, what was not contemplated in the deal, or where did we miss the mark, right? Because you kind of don't know what you don't know. And as each day goes, as you're getting into and unfolding this huge $5 billion deal, you kind of see what you missed, or you see where you missed the mark. And that was our job. And so we were, I can't even remember the number, but you can imagine how many amendments were coming out each month, either changing or further defining the relationship. And that's what our team was doing.
Definitely. And that's so fascinating because I think it's incredibly hard to get everything right the first time, especially if you're dealing with such a big deal and so much infrastructure and components, etc. And so as an outsider, it's often difficult to understand just the effort that goes into a partnership once it's signed. You assume then the other teams are handing it over to all the other teams, but in reality there's so much work your team still has to do. What was the mechanism for conflict resolution in those moments when it wasn't clear, is this on us, is this on you, who's going to be responsible, who's going to pay for it? I think that's always a big issue as well. How did your team navigate that?
Yeah, great question. And so we had daily working team meetings. And so literally there was representatives from the Ericsson teams, there was representatives from the Sprint teams, and literally every morning from typically at least 8 to 9 o'clock, we would meet in this war room and we would just go through all of the different open items, open issues. And then once a week, we had a governance level meeting. And that's where the VPs would come in, and they were in the conversations as well. And then that's really where decisions were being made of, okay, here's something new. this is an add to scope, and
Yeah.
this is kind of the rules that we set up of how we're going to work through that. And then it would determine who pays for it and what that looks like.
Yeah.
But yeah, so there was working teams that were literally together every day working through it. And then we had a governance team that kind of rode over the top that helped to work through the decisions that needed to be made.
Yeah. That diligence is so important, right? Like having like that daily meeting or having like at least this regular check-in point with the other team. Like it might seem like redundant on certain occasions, I assume. Like it's not like every day there was a fire burning, or at least I hope it wasn't every single day there was an issue. But having that regular check-in point to also get ahead of issues and like allow for like just free-flowing communication is crucial.
Yeah, you mentioned the word, it's communications. And that was absolutely key. We all know trust, right? Relationship building and these sorts of things. But it really is like person to person relationships that helps make these things go. But yeah, I mean, there were so many different moving parts, so many different pieces that, I mean, you just cannot know all of the different things there are in this. So as it's unfolding, I mean, at least for the first 2 years, there were working team meetings every single morning. Imagine that, right?
Yeah.
A lot of our partners, we might meet with them like once a quarter.
Yeah.
A meeting with them a lot is once a month. Imagine doing
Yeah.
it every morning, as you're cruising through, because there's hundreds and hundreds and hundreds of different topics and issues and pieces and moving parts. It was
Yeah.
wild to see.
Yeah, the higher the stakes, the more rigid your communications has to be, the more formalized, right? Because you don't have as much room for error at that point anymore. If
Yeah,
you
and
if
we
you
knew
have
that.
a failure, like people lose their internet connection or again.
Yeah, it was so important to get off to a good start and a positive start, and just to build that positive momentum and have the positive relationships. So I think that's why we intentionally kind of put forth that significant investment of being connected. And just one part of that is working sort of externally with your partner and having those relationships, but just internally alone, trying to stay aligned and connected, and even developing you're developing relationships internally, with a
Yeah.
lot of different people as you're putting this together. So certainly a lot of moving parts.
Yeah. Like one of my favorite quotes you mentioned in a different talk was companies don't partner with companies, people partner with people. And that trust between people is only built through these regular interactions and seeing them regularly. And also like making sure that their behavior is consistent,
Yeah.
that they behave similarly every time, that you actually follow up on anything you mentioned to them as well. And that creates that trust which you need if things inevitably will go south at some point. Um, I wanted to just, make sure we get this in as well because I wanted to just ask like how the deal played out. Like it's a $5 billion deal. Like what was the final result, or how long did it last, and like what do you think could have happened differently, or what were the key lessons from this deal?
Yeah, so I ended up leaving Sprint in 2012, so just a little over 10 years ago. And so it was about halfway through this deal, but it ended
Mhm.
up going 7 years. And they ultimately decided to terminate the agreement and kind of to wind it back to how things were. So ultimately, I guess you could say it failed, or it didn't go through. It didn't kind of complete. And
7 years is a long time.
7 years is a very long time, especially kind of in the business world. But
Yeah.
I think there's a lot of different reasons for that, but certainly, again, it looked a lot like an acquisition, and we all hear about acquisitions of cultural clash. And so I think that was maybe like a piece of it, was kind of the cultural part,
Yeah.
of the reason that didn't work out. But I think, just in the end, just the pure economics of it didn't prove through to be significant enough to keep it going through the relationship like that. Um, and then Sprint was also, I think, starting to become interested in selling. Right, they sold a few years ago to T-Mobile, and so I think another piece of this is an impending sale being on the horizon. They thought it would be cleaner if they pulled it back in house. I suspect, I don't know, but I suspect that was probably another piece of it as well.
Yeah. It's interesting because there are so many considerations which you as the counterparty might not even know about, right? Like Ericsson might have had no idea that there is an impending sale planned. And so in their mind, it was just a purely economic terms, like, hey, we're saving you money, this is great. But then there were all these intangibles floating around, like unknown unknowns, which you couldn't have predicted.
Yeah, exactly. But that just kind of goes back to what you were talking about, the power and the importance of relationships
Yeah.
and being able to get as much information as you can. It's amazing whenever you have a really deep relationship with somebody of how much they will divulge, your partners that you have. We talk about emotional intelligence being kind of one of those
Yeah.
superpowers of partnering professionals. That's one of the things that I try to really be, have top of mind with our partnerships, is having that high emotional intelligence.
Yeah, it sounds fluffy, but at the end of the day, it really boils down to that. It really boils down to like intel, like
What
what kind of like
matters?
information are you getting, and like what kind of trust are you developing? And because in that moment, like you might get information when things are going south, and when it's really important to still understand what is happening, so you can interject. We are heading up on time. Like this just flew by, this half an hour.
Yeah, it was
So
fun.
we might, yeah, this is great. We'll definitely have to have you on another time. But before we go, I just wanted to ask you, like, what was like the one lesson you think everybody should take away from your experience with this alliance, or just strategic alliances in general?
Yeah, so I kind of alluded to it earlier, and this sounds super cheesy, but still, it's 14 years later, and I still remember it. But our VP had this cheesy word, partnerlicious. I was like, that is the weirdest, goofiest word I've ever heard. What the hell does that even mean? And his directive was, is your decision best for the partnership? And if you were in your partner's shoes, would you take it? And answer that question first. And so this goofy word partnerlicious is stuck in my head, but that's what it meant. And so, like, literally, whenever we were in these war rooms, our working teams, the governance team, and there was an issue, and we had a proposal that we wanted to share internally before we took it to Ericsson, VP would always say, "Is it partnerlicious?" And it caused you to stop and think. So as goofy as it is, that's my takeaway.
That's amazing. I don't think I'll ever forget that one. It's
I
just so
know, right?
goofy and cheesy, but at the same time, from now on, every time I'll ask if it's partnerlicious, because it's so important. And as a partnerships leader, I always catch myself like not thinking about the partner enough, like not putting myself enough in their shoes, and then being surprised by information they reveal. Where I'm like, well, if I would have thought this through better, like it would have been very clear to me that
Yeah.
this is actually a concern for them. But because I was always stuck in like my frame of mind, that never came up.
Yeah. And I think if you truly have your partner, their best interest in mind, it's so hard to kind of, you got this zero sum mentality. It's just natural for humans to have this zero sum mentality. But if they truly believe that you want them to win and you want them to succeed, it's no longer me versus you, but it's me and you. I call it negotiating from the same side of the table.
Yeah.
That's where you need to be in these partnerships, in these relationships, because that's where you win. It's you and your
Yeah.
partner versus the market opportunity. It's not you versus your partner.
Yeah, I love that. Like it's you and your partner partnering against the market opportunity, or against a common threat, maybe even like maybe there's a different player who's trying to infringe or something like that. Like you and your partner have to negotiate already on the same side in order to like kick it off on the right foot, because otherwise it's awkward. Like if you start as like opponents and then like flip the table and go like, okay, now we're friends. Like that's never going to work out, right? You have to start off as like mutual respecting partners from day one.
Exactly. And that's a
Awesome.
skill. That's a skill for sure.
Yeah. Well, we are already 4 minutes over time, and I don't want to take up too much of your day, Mark. You've been already very generous. But before we leave, we did mention there is a giveaway, and so I told Mark that I wanted to give away one thing to one lucky winner in this raffle who dropped hashtag this ship into the chat. But Mark actually like exceeded that and said, "Why don't we just give something to everybody who joins today's session?" And so I'm super excited that Mark offered that if you go onto partnernomics.com/free, you get $595 worth of content for free for watching this show today. do you want to say a little bit more about just the piece of content everybody's getting?
Yeah, sure. So it's our Partnering Foundations course, our first course. You get the course for free. We're also throwing in the certification exam for free, as well as the LinkedIn digital badge after you complete that certification. So it's a university-backed certification, and you can toss it on LinkedIn and show your friends, your boss, your peer, new hiring managers that you have some awesome skills.
Awesome. Well, I'll definitely have to get mine. I now have my weekend plan sorted.
There
And
you go.
yeah, thanks so much for taking the time today, Mark.
Yeah, thanks for having me.
This flew by, and I also want to give a shout out again to Andres, Daniel, Marco, Antonio, and Ignacio for joining us live today. Really appreciate you. You could have been anywhere, but you chose to spend this time with us, and that really means the world to me.
Well, thanks for the
Thanks a
invite.
lot, team.